Long before Wall Street, Nasdaq, or the JSE existed, human beings were already wrestling with the same question as we are today. How do you turn your hard-earned wealth into a safer tomorrow? Now let me take you back to ancient Mesopotamia. This is roughly about 1700 BC, and some of the earliest clay tablets recorded in what we call the Code of Hammurabi. Early pledges of collateral, interest, risk sharing, some of the earliest known frameworks for investing. And these were in agriculture and trade projects. So for example, farmers borrowed silver to plant crops and promised to pay it back after the harvest. Later in the Roman Empire, soldiers who served long campaigns were rewarded with land, or typically silver. And that was the empire's way of saying, your sacrifice today secures your future of tomorrow. And this was most likely the earliest form of institutional retirement as we know it today. In the 1600s, European powers dominated global trade. They sent ships all over the world, Amsterdam, London, Lisbon. And for the first time, ordinary people could buy a share of the ship. If the ship returned full of spices, your wealth multiplied. Unfortunately, if it sank, you lost everything, which also paved the way for insurance. But that was the birth of modern day investing. Fast forward a couple of centuries later, in the late 1700s in America, 24 brokers under a buttonwood tree signed what became the Buttonwood Agreement, the foundation of the New York Stock Exchange on 17 May 1792. That deal formalized the trade and the trust for the West as we know it today. Meanwhile, in South Africa, the notion of social pensions began in 1928. Over the decades, private pension funds, provident funds, and retirement vehicles emerged. In 1956, the Pension Fund Act was passed, giving structure and regulation to retirement investments in South Africa as we know it today. The government recognized that many South Africans never touch formal retirement funds, especially younger people or informal workers. So in 2015, I can still remember this was early days when I joined the industry, they launched the tax-free saving, a TFSA, a way to slightly bend long-term investment, let people compound growth without tax, and open the door to more global opportunities. So today, both exists. The RA, a tool built for long-term retirement structure under regulation, and the tax-free saving, a more flexible, freer, newer tool for growth. We have events across South Africa in different campuses, and I'm proud to say, whilst recording this episode, this year we've achieved a monumental milestone where we've shared and empowered content in person. So this is in-person events to over 2,000 medical students in their final years. And the question that always leaves these guys stunned is which one would perform best? Retirement annuity, the one that's always been there, or the new tax-free saving? If I invest 100 Rand in both of them, which one will leave me best off? And in this episode, we're going to unpack that query. We're going to look at what is the difference between the two. Right up next. So important. The growth of the investment is not determined by the actual investment itself. This is very important. So if I invest 100 Rand or 100% of my budget in an RA and 100% of the budget in a tax-free saving, they will perform exactly the same. Exactly the same. Growth is not determined by the investment vehicle. Growth is determined by the underlying asset classes. And I've done a phenomenal episode. If you haven't watched the episode, go watch our episode on asset classes, where I explain what's the difference between shares, property, bonds, cash. Those are the sort of asset classes that determines the growth of the investment. And I know what you're thinking. You're saying, but Stefan, if I invest 100 Rand in an RA and 100 Rand in a tax-free saving, what's the difference between the two? And I'm glad you asked that question. That is probably the most important question that you can ask. Is the only difference between these two investment vehicles is the tax framework, the legislation, the way they are wrapped. What is allowed, what is not allowed, where you can invest and where you're not going to invest. And in this episode, we're going to talk about the three main differences. So let's start with the first one, exposure, where you may invest. With a tax-free saving, it's important to note that you can invest 100% offshore. Some platforms have reached their offshore limit. So this is something that you will have to discuss with your advisor or with your investment platform, which means that they can't go more than 45% offshore. The limit has been reached. But you can, if you're on a platform where it's still allowed, you can go 100% into an offshore unit trust, ETF, S&P 500, East, India. You can go anywhere in the world, invest anywhere. With a retirement annuity, you are capped to 45% offshore and you're capped to 75% equity. You are regulated by what we call Regulation 28. That means that your RA can't go more than those predetermined avenues. If you want full exposure to the US, you're limited. So please don't see this as advice, but why I would recommend introducing a little bit more offshore, especially if you are young. If you invested 100 Rand 10 years ago into the Joburg Stock Exchange All Share, JSE, okay, that would have doubled up in 10 years. So today you would have had 200 Rand. If you took that 100 Rand and you invested it in the S&P 500, it would have quadrupled. You would have had 400 Rand. This excludes the effect of a depreciating or weakening Rand. So in an emerging economy like South Africa, again, this is not advice, please talk to your financial advisor. I feel a tax-free saving allows you the opportunity to go beyond your 45% limit if you look at both of them as your retirement solution. The second one, contributions. So from a tax-free saving perspective, you can only do 36,000 Rand a year and you can only do 500,000 over your lifetime. All the growth, everything that grows on it is 100% tax-free and it won't be part of the contribution. So literally, contribution is only what you put in to the investment. However, everything that you over-contribute, SARS nails you with a massive tax penalty. So please, because I get a lot of people, I want to do 50,000 in a tax-free saving, or they do 36 in one tax-free saving and then they go to the bank and they do another 36 there. SARS picks it up. Both of them are institutions that has to report to SARS. The moment you submit your tax returns, there's going to be a tax penalty. With a retirement annuity, I did a full episode on retirement annuity in the link below. Please watch the episode. This is where we talk a little bit about why we would recommend a retirement annuity as well. Contributions on an RA, unlimited. You can invest as much as you want, but from a tax perspective, only 27.5% of your contributions will be allowed to be deducted for tax purposes. And they cap this for high earners to 350,000 Rand a year. If you're in a high tax bracket, that deduction means SARS gives you money back now. So for every 1 Rand, if you're on a 45% tax bracket, for every 1 Rand you invest, 45 cents is going to come back to you. Then lastly, accessibility. This is the last point. With a tax-free saving, you can access your money now. It's flexible. You can access it. An RA, subject to the two-pot system, you can access your savings component 1/3 now and 2/3 only at the age of 55. So if you're watching this and you're wondering which one, I want to maybe summarize by saying the RA is your anchor. It's your foundation. You get the tax deduction now. It's locked up for retirement. Your growth is still tax-free. You are a little bit capped to offshore, but it's a slow snowball that grows towards retirement. A tax-free is your speedboat. It's flexible. It's something that you can access. It's something that allows you a little bit more offshore, a little bit more equity. It gives you that flexibility to get a bit of a growth strategy, especially if you are still young. It is also important to note that none of this will work unless you follow the golden rule. Warren Buffett says that you have to pay yourself first. Don't wait for leftovers. The wealthy don't save what's left. They save and then they spend what is left. And rule of thumb, I always say this, you have to be saving at least about 15% towards your long-term goals. Automate it, make it untouchable, month after month, year after year. Wealth is not built in a single year. Wealth is built consistently, little by little, compounding over time. The bulk of your wealth will happen in the last 4 years prior to retirement. If you found this episode valuable, give it a thumbs up, subscribe in the link below, and share it with some of your friends. Share it with people that want to maybe invest in a tax-free saving or in a retirement annuity. Check out some of the other content that we've done. And until next time, plan the plan.